Today I'm going to show you how to build the perfect crypto portfolio for long-term gains. This is the process I use to build clients' portfolios and the one I use to build my portfolio. But why is it so hard to build a crypto portfolio? Well, for starters, there are literally over 25 million altcoins at this point, and it's growing extremely fast. And it's impossible to compare all of these altcoins because for once they all sound amazing, right? They're all going to change the world and they're all going to make you a gazillionaire overnight. But what makes them so hard to analyze is the lack of transparency. These are not regulated companies that have to file annual reports or quarterly earnings and stuff like that. They can just do whatever they want and tell you whatever they want, basically. And this decentralization, this lack of a company that has to file reports and stuff like that, it makes communities a way that people gather information. But the problem is that these communities get really tribal. And if you look at the communities of XRP, for example, or ADA, for example, they are super aggressive and everything else is just a scam. It's just trash. This is the coin that's going to surpass Bitcoin. And oftentimes it's just BS. And oftentimes most of these tribal communities just hold on for dear life to some dead project. I'm not saying XRP or ADA is dead, but these communities could probably be better off by diversifying. Let's just say that. But the point is that crypto is super confusing and building a portfolio is really hard because there's way too many coins and it's impossible to compare them because there's a lack of transparency about the information. Maybe you're used to analyzing stocks or real estate. Well, at least you know the information that you can base your analysis on. There's objective like metrics and stuff like that. You can check the earnings of our company and look at the price per earnings and stuff like that. But that's why I have built this three-step approach. That's a more mathematical way to build a crypto portfolio. The first step is to plan your sector allocation based on risk tolerance. If this sounds confusing, don't worry, I'm going to show you exactly what to do throughout this video. The second step is to research and analyze the coins in different sectors and pick the best ones based on fundamental and the technical analysis. Third, we have execution. That's all about buying the actual coins. You have dollar cost averaging, and you have lump sum investing, and you have dynamic dollar cost averaging, which is the best way to do it by far, in my opinion. But before I get into each of these steps, let me tell you about 5 of the most common pitfalls I see crypto investors falling into. The first one is thinking that you found the next Solana or the next Bitcoin or whatever. This is a huge mistake because people just go all in on one altcoin that they are convinced is going to the moon. 99.9% of the time they're wrong, and the 0.1% times they're right, they still fail because they buy and then the coin explodes, but it crashes back down before they get out. So even though you find the next Solana or the next Bitcoin, you still fail if this is your strategy, right? So this is a wrong way to do it. Maybe you can look for the next big thing after you have built a strong portfolio and you can play around with some casino money or whatever. But this is not where you start when you want to build your portfolio. You're not going out looking for the next Solana. I'm going to show you a way better approach. The second one is not realizing that they all sound amazing. And this is really connected with the first one, because when you start looking at altcoins, all the altcoins sound super amazing. They're going to change the world. It's going to explode in value. You're going to get rich if you buy this coin. But that's rarely the case. And you have to realize that they all say that. They all sound amazing. You have to really think about it before you actually buy into their rhetoric or their arguments or whatever. So just understand and realize that they all sound amazing. And don't ignore the fundamentals. There's a lot of hype in this space, and oftentimes you're buying into plans and dreams about what the future is going to hold. Just realize that anyone can write a white paper and say that they're going to change the world. That doesn't automatically mean that they're actually going to execute on this. So you have to look at the fundamentals. Who's behind this? Is this a good team? If it's some random 17-year-old from Sweden or Norway, like I'm from, and he says he's going to change the financial system from his basement, that's probably not going to happen. So don't just look at the promises they make. Also look at the fundamentals, the team behind it, and stuff like that before you actually start believing in the project. Fourth pitfall is to chase the hype. I see a lot of people just going to YouTube or going to Twitter and just looking up the top 10 best altcoins to buy in January 2025. And let me tell you, if you find a top 10 altcoin video with 5 million views and you buy the altcoins in the video, it's too late. I'm sorry to say it. Everyone has bought already, so there's only sellers left. So don't chase the hype. You have to get in before the hype. The final one is to not realize that everything you know is probably priced in. If you read some news article, or if you like talk with some guy, or you see some YouTube video or see some tweet or something like that with some interesting information that makes you think, oh, this coin is going to explode in price. Most likely, everyone else knows it as well, and it's already been priced in. You have to buy stuff before everyone else knows about the news. This is like a mental thing that's good investors from traditional markets understand this, but most new people, most retail investors that haven't like really analyzed something or been in the market for long, struggle to grasp this priced in notion. If you know something, most likely everyone else knows it as well. And if everyone knows it, it's already priced in. So for example, the Bitcoin halving, right? Most people thought that the Bitcoin halving was going to be this huge event, and right after the Bitcoin halving, the price was going to explode. Of course it didn't. Everyone knew the halving was coming, and everyone bought before the halving in preparation for what they thought was going to be a price explosion. And so it's priced in. That's what I'm trying to say here. So realize that if you know something, most likely everyone else knows it as well. So that's the most common pitfalls. Please try to avoid these. You're probably going to make a mistake or two, but please just avoid these specific ones. Don't do the same things that I did. I'm talking from experience here. So before we get into the steps, we have to define what the perfect portfolio is. And this is my definition. It's a collection of fundamentally strong and technically bullish coins diversified across sectors and market caps according to risk tolerance. So that's a mouthful, but I'm going to talk you through it and show you exactly how to achieve this goal or this definition. So you have to diversify across the sectors. So the first step is to actually plan your allocation to these sectors. So what's a sector, you might ask? Well, the altcoin market can be split into categories or sectors. You have different kinds of projects that are really similar. So you have, for example, you have the DeFi coins. This is decentralized finance. So everything that has to do with lending, borrowing. You have decentralized exchanges where you can swap coins, stuff like that. That's all DeFi coins, and that's a sector of the altcoin markets. Then you have, for example, DePIN. So that's decentralized physical infrastructure networks. So that's computers spread across the world that offer like a GPU and compute and stuff like that for AI firms, for example. So you can just go into one of these decentralized networks and you can lend compute services or GPU in a decentralized manner. And all those types of projects we call DePIN. Then you have infrastructure projects, which are basically fundamental innovations that make other sectors better. You have, for example, Chainlink. It enables other blockchains to talk with the real world without getting into the technicals, but it makes other projects better. That's why it's an infrastructure project. Then you have the layer ones. These are the fundamental blockchains like Ethereum, Solana, Sui, BNB, and you have the Avalanche, all of these chains that other stuff can be built upon. Then you have layer twos. These are the scaling layers for Ethereum mainly. Like Base, you have a Polygon, you have Arbitrum, all of these layers that are built on top of Ethereum to make Ethereum more scalable. Then you have meme coins, which is this weird sector with no utility at all. All the focus is on the community and how many holders there are and spreading the memes across the Twitter space and stuff like that. So this is a weird sector, but it's all about community. That's what you need to think about. Then you have GameFi. This is just game finance. So these are actual games that we can play and you can earn money by playing the games, for example, because maybe you're playing a role-playing game. You're running around like a Viking. I would like that game because I'm from Norway, right? So I would run around like a Viking and I would find some axe on the ground maybe that I can use to kill zombies or whatever. And this axe might be an NFT. So I can take it out of the game and I can sell it on a marketplace. Or I can buy another axe on the marketplace that's better than mine, and I can bring it into the game and become a better Viking. So this is an example of a game with blockchain technology. So we put that into the GameFi sector. And there's also infrastructure products in that sector, like these tokens that you can use across multiple games, like Super, for example. Then I have artificial intelligence, and this is a sector that covers like AI agents and stuff like that, everything that has to do with AI. So we have like decentralized large language models and that kind of stuff. Then you have real-world asset tokenization. This is also a new sector. This is focused on tokenizing real-world assets. So for example, real estate or bonds and stuff like that. So these are the main sectors that I'm going to talk about and that you should consider to have in your portfolio. And how much are you going to put into each of these sectors? That's the first thing you need to figure out. This is the first step. You need to figure that out before you even analyze any coins. And we're later going to use this plan to fit coins into the plan. So we begin by saying, okay, these are the sectors I want to invest in. And I want X% in DeFi, I want Y% in meme coins, I want Z% in layer ones. And then we go out and find coins that are strong fundamentally and bullish technically and put X% into each of these DeFi coins and Y% into each of these meme coins and Z% into these layer ones. Does that make sense? Okay, so let's move on. The allocation to the different sectors, of course, depends on your risk tolerance. So you have to define your risk tolerance on a scale from 1 to 10. And the factors that you need to consider are your age, your financial situation, your family situation, and your risk appetite. So your age matters because if you're 20 and you lose everything, no one really cares because you have 40 years left to build yourself back up. If you're 61 and you lose everything, that's a big deal because you're going to retire soon, right? So you need some assets built up. So if you're older, you have a lower risk tolerance. Your financial situation also matters a lot because if you have a lot of other assets, for example, if you have some rental apartments, you have a lot in the stock market, and you have some bonds maybe, then you can afford to take more risk in the crypto space because if you lose everything in crypto, you still have other assets to fall back on. Your family situation also matters a lot. Because if you have other people depending on you financially, it's just not responsible to take the same amount of risk as if you were all alone and no one else was harmed if you lost everything. So if you have a family that depends on you financially, don't go all in on some meme coin in a leveraged position like this guy. Don't be this guy if you have a family. That's what I'm trying to say here. So figure out your risk tolerance on a scale from 1 to 10. And I'm going to give you some examples of allocations depending on that risk tolerance. So this is a portfolio I built for a client, and I'm just going to show you the diversification across sectors. This guy had a risk tolerance of 6 out of 10. And I put 40% in index. Index, that's just Bitcoin. And layer ones, 25%. And that's the Ethereum, the Solana, the Sui, stuff like that. Then you have DPIN, that's again, there's decentralized physical infrastructure networks. You have Render, you have Tau, you have a cash network. All of these are deep in place. Then you have 9% in DeFi. So that's Uniswap, that's Aave, that's Jupiter, all of these DeFi plays. Then you have infrastructure, 7.5%. So that's Chainlink, that's maybe some PIT network, maybe some Filecoin. Then you have meme coins, 3%. These are super risky because they're proudly, explicitly saying that there's no use case, and in some way they try to make that a good thing because there's no execution risk, right? You get what you get, and there's no plan to build anything, so they can't fail, right? But anyways, 3% in the meme coins, and these are, Dogecoin, Shiba Inu, Pepe, Brett, all of these coins are meme coins. And you have 3% in gaming. And the reason I built it like this is because meme coins and gaming are the riskier sectors. Metaverse and NFTs are also super risky, so I didn't put anything in that, and I'm actually not that bullish on that sector. But gaming and memes, I'm actually really bullish on, but they're so risky that a 6 out of 10 can't put more than 3%, maybe 5% in each of those categories. in my opinion. And of course, index, that Bitcoin. And we want to have Bitcoin as the biggest position, at least if you're below 7 in a risk tolerance. Because Bitcoin, that's the safest one, right? Because you only have the systemic risk of the crypto market, or the systemic risk and the idiosyncratic risk are the same for Bitcoin, because Bitcoin is the system. So yeah, without getting too deep into that. But yeah, so this is an example of a 6 out of 10 portfolio. This is an example of an 8 out of 10 portfolio. So here I put actually 26% in layer ones. So that's again Ethereum, Solana, Siri. And I put 25% in index. Again, that's just Bitcoin. 18% in memes. That sounds insane if you're new to this space, but actually meme coins is one of the best performing sectors of all of 2024. So, and I think the trend is going to continue in 2025. And I have a large hypothesis. If you're interested, send me an email. But yeah, so meme coins, 18%. DeFi, 12%. Again, that's Uniswap, that's Aave, Jupiter, Radium, all of these DeFi plays. Deepin, 8%. Again, that's Render, a cash network. AI, 3%. Layer 2s, 2%. Gaming, 2%. But the main difference is more meme coins and less Bitcoin. And that's why this guy has a larger risk tolerance. So these are 2 examples. You have to figure out your risk tolerance and your desired allocation to the different sectors. And there's no right or wrong way to allocate to the different sectors. You have to figure it out based on your goals and your risk tolerance. I'll put some more examples below this video. So that covers step 1. You have to define your risk tolerance and plan the sector allocation. Again, you can see all of the factors that your risk tolerance depends upon and the allocation to the sector depending on the risk tolerance examples in the text below the video. So go check that out after the video. Then we have step 2. This is all about research and analysis. This is where we find the coins and we analyze them, depending on the sectors that you choose to allocate capital to from step 1. So you have to make a prospect list. This is just a list of potential coins from different sectors within different market caps. That sounds complicated, but basically you just look at the sectors you picked in the first step and you go and find different coins in those sectors. And then we turn that list into a golden list. This is removing all the bad coins, basically. We're going to analyze the coins fundamentally and technically to find the best coins on your prospect list. And that's going to leave you with a golden list of fundamentally strong and technically bullish altcoins in the sectors that you planned to allocate capital to. So, what to do? That's the main question, right? First, you need to find altcoins in the relevant sectors. You just go to coinmarketcap.com and you look up the sector that you want to allocate capital to, and you make a list of 3 to 5 coins in each of those sectors. So let me just drag CoinMarketCap up to the screen here. So this is a search bar. You just type in decentralized finance, and then you hit the categories. Oh. Let's try DeFi. Yeah, okay, so just DeFi for short. Let me just go into this, and you can see all of these coins are in the DeFi sector. But you should be aware that most of these coins are in multiple sectors. So you have to actually analyze them. Like for example, Chainlink, I would not call that a DeFi coin, but it's in the DeFi sector because it's involved in the DeFi space, but it's an infrastructure coin. And Avalanche is layer 1. But Uniswap, that's a pure DeFi play. That's a decentralized exchange. So is DAI, or that's a stable coin, but it's a decentralized stable coin. Aave, that's the leading lending protocol. Athena, Radium, Jupiter, Stacks. Stacks is they're building the DeFi layer on Bitcoin, but it's actually a layer 2. But anyways, Injective is a layer 1. But okay. So this is how you find new coins in the sectors. And just to double check that it's actually a DeFi play, you just click on the coin. And then you click on About. You can read a little bit. So Uniswap is a popular decentralized trading protocol, known for its role in facilitating automated trading of decentralized finance tokens. So this is proof, basically, that it's a DeFi play. All right, so let's put it on our list. And then you repeat the process until you have about 3 to 5 coins in each of the sectors that you plan to allocate capital to. After that, you need to analyze them fundamentally. So you need to find numbers about the adoption, basically. So how many people are using Uniswap, for example. And then you need to compare that with the market cap of Uniswap. So you want to find the ones with the most amount of adoption, but are with the lowest market cap, because you want cheap coins relative to the adoption, basically. Actually, let me bring up Uniswap again, and I'll just show you what I mean by this. So let's go to DeFi Llama. That's a data aggregator. That's a place where you can analyze decentralized projects. So actually, we can just do a search, Uniswap. There it is. And here we get some numbers. This is the numbers that tell you about the adoption of Uniswap. So you see the market cap, that's the pricing or the valuation of the company, if you will. It's not a company, but you get the point. And what we are interested in here is the volume, because decentralized exchanges, you can ask yourself, what's the function of a decentralized exchange? Well, the function of a decentralized exchange is to facilitate trading, right? So higher volume means higher adoption. So in this case, we want to see a high volume, right? And we also want to see the historical, how it's progressing over time. A lot of stuff going on. Let's remove TVL and just look at volume. So we can see that it's trending up. It's been trending up since September of 2023. Higher highs and higher lows. And this is great. This indicates that the usage and the adoption of Uniswap is increasing over time, and it's trending up. And with the market cap of 6 billion, let's look at the market cap historically. All right, so it's actually pretty low compared to what it was. So if we look at 2021, this is the peak of the previous bull market. We see that the market cap was 21.5 billion, while the volume was 42 billion. In December, the market cap was 8 billion, and the volume was 111 billion. So the market cap is kept in third, right? So it's 7 instead of 21 billion. But the volume is over double. And this tells us that Uniswap might be underpriced at the moment compared to the hype levels of 2021 at least. And I think we're going into a similar hype wave as in 2021. We might expect not the same overpricing, but maybe something similar. But at least right now, the adoption is more than double what it was, and the price is 1/3, right? So this indicates that Uniswap is underpriced. But before you go all in on Uniswap, you have to check out the other decentralized exchanges. Are they more undervalued than Uniswap, or are they less undervalued? Maybe they're overvalued even. But you get the point. You check out the adoption, and then you check out the market cap, and you figure out what the ratio is. And then you compare that ratio to other projects and historically to maybe 2021, because that's the post-halving year of the previous cycle, which is kind of similar to what we are entering now in 2025. Yeah, you get the point. Check out the coins fundamentally. After you've done the fundamental analysis, you want to do the technical analysis. So the main question you should ask when you analyze it technically is it outperforming Bitcoin? Because if the coin isn't outperforming Bitcoin, what's the point of taking on the extra risk of holding altcoins? So again, you can just go to coinmarketcap.com like this, find the coin that you're looking for by searching in the search bar on the top right, scroll down a little bit, and then you compare it with Bitcoin. And now you can pick different time frames, right? So let's look at the yearly, for example. So at this time, they started out at the same point, and you can see that Uniswap exploded 140% in March of 2024, but then it crashed back down. So you can see that it's way more volatile than Bitcoin is. And in the summer of 2024, the Uniswap price was down 7%, 8% basically, and the Bitcoin price was up 27%. So you have even though you got 140% rally back in March, you were still down. That's horrible. But then Uniswap rallied again by almost 200%, and the Bitcoin is up only 130%, right? But then Uniswap has crashed back down again. And now the Uniswap price is only up 81%, but Bitcoin is up 140%, right? So what you want is to find altcoins that actually outperform Bitcoin over time. And before you go all in on some altcoin, you have to check that it's not at some of these peaks, right? So you want to buy when it's below Bitcoin. And if you look at the all-time, yeah, this is a horrible picture for Uniswap, because at some point it was actually outperforming Bitcoin by 1,000%. But now the story is not the same. Over double the returns with Bitcoin. So yeah, you get the point. You have to try and figure out if it's outperforming Bitcoin. So you want to do this with all the coins on your prospect list. You want to compare all of these coins by their fundamentals divided by market cap, or the ratio between market cap and fundamentals. And you want to look at them technically. Are they outperforming Bitcoin? And then you want to remove all the coins that are fundamentally weak and technically bearish, aka underperforming Bitcoin. You should be left with a list that only include coins that are fundamentally strong, technically bullish, likely to outperform Bitcoin, and in the sectors that you plan to allocate capital to. So this is the golden list, and it's tailor-made for you specifically, based on step 1, like the sector allocation you planned. So basically just make a prospect list, find coins on the sectors or categories page on CoinMarketCap, and then you analyze them fundamentally and technically to create your golden list. Step 3 is execution. This is where you actually buy the coins. So you need to figure out how much do I want of each of the coins, and then figure out how do I actually go out and buy them. Should I dollar cost average? Should I lump sum? Or should I do it dynamically? And the dynamical DCA, that's the best way to do it, in my opinion. I'll tell you what that is in a second. So this is an example of how to allocate to each of the coins on your golden list, depending on your sector allocation that you planned in the first step. So let's assume this was our plan, right? So we want 40% in index, that's just Bitcoin. We want 25% in layer ones, okay? So on my golden list, I had 3 coins. I had Ethereum, Solana, and Sui. And I have to allocate 25% of my portfolio to these 3 coins. And I landed on 10% to Ethereum, 8% Solana, 7% to Sui. I also allocated 12.5% of the capital to DePIN. That's the sector that's a decentralized physical infrastructure networks. So you have coins like Render, FET, Tau, and Akash Network. These are the DePIN coins from the golden list. So I put 4% in Render, 3.5% in FET. You have 3% in Tau, and 2% in Akash Network. So this is the distribution of the allocated capital in the DePIN sector. You have DeFi in 9%. So let's find the DeFi place there. You have Ondo, and you have, let me see here, Aave and Uniswap. So 2% in each of those and 5% in Ondo. That equals 9%, right? That was the plan. And then you just do the same thing with all of the sectors you planned to allocate capital to. You spread how much you plan to allocate into the coins from your golden list. That's the basic plan here. And then you calculate the market cap diversification to check that it makes sense according to your risk tolerance. So if you have a low risk tolerance, if you hate risk, you want mostly large cap altcoins. If you love risk, you want more small and micro caps. So this is a guy that doesn't love risk. This is one of my clients. He didn't want any like high risk plays. So there's no allocation to micro caps. These are the 100x potential coins. He didn't want any of those because they're more likely to go to 0 than go 100x. And he didn't want anything going to 0, or of course anything can go to 0, but you get the point. So this is an example. This is what you have to do. Find all the coins in your golden lists and rank them by sector and allocate the capital that you planned in step 1, spread across those coins, like in the example here. Now it's time to actually buy the coins. Are you going to dollar cost average, just regularly buy, spreading your risk over time? Are you going to lump sum invest, just throw everything in at once? High risk, but if you time it correctly, it's way better than dollar cost averaging. Or are you going to mix both and do dynamic dollar cost averaging? So I dynamically dollar cost average. That's what I do personally, and that's what I teach my clients to do. That just means to dollar cost average. So spread your risk over time by buying a little bit, weekly maybe or monthly, but you dynamically adjust the amount you invest based on the price movements. So let's say I want to establish a position in Ethereum, for example, and I plan to allocate $10,000 to Ethereum. Maybe I buy, say, 3,500 immediately, just to establish the position. And then I want to buy weekly until I fill the $10,000 planned position. Instead of just investing a fixed amount every week, if the price goes down, I'm investing more. If the price goes up, I'm holding back a little bit. I'm investing maybe half of what I planned to do every week. This way, you get a lower average buy price, and it decreases the risk a lot, actually. So this is the best way to do it, in my opinion, dynamic dollar cost averaging. And I personally like to establish a position immediately, like maybe 30% of the capital intended to invest in, for example, Ethereum, and then dynamically dollar cost average the rest. So because if the price explodes tomorrow and I only invested 5%, I'm going to hate myself. But if the price crashes tomorrow, I still have like 70% left to throw into it. So it's the best of both worlds. It's a summary of the 3-step process. You need to plan your sector allocation according to your risk tolerance. You need to find the good coins in each of the sectors and make a golden list. And then you need to allocate to those coins with preferred buying tactics, so dynamic dollar cost averaging. At this point, you're probably wondering, but what coins should I buy? Just tell me the coins. Well, I can't do that because of 3 reasons. I don't know where you live, so I don't know what exchanges you're using. I don't know at what time you're seeing this video, so I don't know what's happening in the market right now. And number 3, I don't know your risk tolerance. Maybe you're looking for a 100x gem that might change your life, but most likely go to 0. Maybe you want to spread your risk and have a more safe crypto portfolio. I have no idea. But what we can do is talk about it on a Zoom call, actually. If you're looking to day trade the 5% swings, I'm not your guy. Not at all, actually. But if you're trying to time the big moves, I am your guy. That's what I'm an expert on. That's what my background is, basically. That's what I've spent the past 8 years trying to master. If you want to talk about potential one-on-one services or get some personalized suggestions, just book a free call below this video. Thank you for watching. I hope you have a great day.